Very good afternoon, dear students. Today, let us discuss about the new topic called cost of capital. We all know what is capital, right? Capital is nothing but it is an amount of investment. It is invested for running the business. What is cost of capital means? The name is itself suggests you that the cost required for managing the capital is called as what? Cost of capital. I'll repeat once again. Cost of capital in the sense the cost which is required for managing the amount of capital into the business is called as cost of capital. We all know there are various different types of capital existed in the business organization. It can be a share capital, loan, reserves and surplus, or even short-term capital. But here we take only the long-term capital for the purpose of calculation. So what is the cost required for cost the company must have to earn to maintain the amount of capital in the business is called as cost of capital. In the same way, there are different types of cost of capital. Let us discuss that based on the capital types of capital. First one is cost of capital. This cost of capital is denoted as K. Cost of capital is denoted as K, and the first type is cost of debt. This cost of debt capital, debt is nothing but loan capital, loan, right? So this cost of debt capital is denoted as KD. Cost of debt capital is denoted as what? KD. And next is cost of preference, and this cost of preference is denoted as KP. And then cost of equity. This cost of equity is denoted as KE. Then cost of reserves is denoted as KR. And finally, the overall cost of capital. This overall cost of capital is denoted as KO. Okay, so let us discuss one by one. First is the cost of capital. So what is called as cost of debt? What is called cost of debt here? The cost, this is a debt capital in the sense borrowed capital. This is external money. When the company has borrowed some amount of capital for meeting their business, for maintaining, managing their business, then for which the company must have to pay regular interest with a fixed percentage, right? There will be a fixed percentage of interest on which the company has to pay the fixed rate of interest for them. So in order to pay fixed rate of interest, what the company must have to do? They have to utilize that amount of debt capital in the business. By utilizing that profit, whatever the return they get, from which they can make the payment of debt capital. So in the similar way here, the cost of debt in the sense, the cost, what is the cost for the debt? Interest. So the interest amount which the company must have to earn by the utilization of debt capital is called as cost of debt. What is the formula? There is a problems. We can discuss that problem and solve the problem relating to this cost of capital. So for which we need to know what is the formula for calculation of cost of capital. So first one is cost of debt, and it is denoted as KD, cost of debt, and this cost of debt is equal to I into 1 minus T into 100 multiplied by 100. What is this I here? I stands for interest. What is this I here? I stands for interest and T stands for tax rate. I'll write at the end for this, where I is interest, and T stands for tax. Next is cost of preference. So cost of preference is denoted as KP, that is cost of preference, the cost What is the cost required for meeting the preference? It is dividend. The amount of dividend the company must have to earn by the utilization of preferential capital is called as what? Cost of preference. So this cost of preference is equal to, usually even for the preferential capital also there will be a fixed rate of dividend. So with this fixed rate of dividend, the company can directly take that into consideration, or you can by using the formula, if they are not given the fixed percentage of dividend, you can calculate by using the formula like preference dividend divided by net proceeds into 100. Next, cost of equity. To meet the needs for the equity shareholders, whatever the cost the company must have to earn is required to earn is called as cost of equity. This cost of capital is also called as required rate of return. The company must have to earn some required amount to meet the to return to the concerned capital holder. That is called as cost of capital. Here, the company must have to earn some amount of money to meet the needs of the equity shareholder. It is called as cost of equity. So here, for the calculation of cost of equity, there are two different types. One is when there is a growth rate, when there is no growth rate. What is the formula when there is no growth rate? When there is no growth rate, the formula for this is cost of equity is equal to earning per share. Cost of equity is equal to earning per share, EPS, earning per share divided by market price per share, earning per share divided by market price per share into 100. This is a formula we use when there is no growth rate. When there is no growth rate, we use a formula like EPS divided by MPS into 100. What is EPS here? I'll write PD, where PD is nothing but preference dividend. Preference dividend. NP is nothing but net proceeds. EPS is earning per share. Earning per share. Then MPS is nothing but market price per share. Market price per share. Okay, so this is about cost of equity when there is no growth rate. When there is a growth rate, what is the formula? Look at here, when there is a growth rate. When there is growth rate, same formula we use, but along with this we add G. What is G here? G is equal to growth rate. G is a growth rate. I'll repeat the formula when there is a growth rate. So when there is no growth rate, we don't consider this the rate of growth. If in the problem, if the rate, that is growth rate is mentioned, then we use this formula, that is by taking the growth rate. When there is no growth rate, directly we take the formula like EPS divided by MPS into 100. If there is a growth rate, add this growth rate to the formula. That is called this is the formula of cost of equity. Now let us discuss about cost of reserve. What does reserve means? This is also called as cost of retained earnings, cost of reserves or cost of retained earnings. What is cost of reserve? What is called as reserve? What is reserve? Can anyone tell me what is reserve? Okay, reserve is also a part of the profit, right? It is a part of the profit. When the part of the profit distributed to the shareholders, that is called as dividend. And whatever the part of the profit after making the payment of dividend to the shareholders, if any amount left out in the company, that is called as reserves or retained earnings. The amount of profit left in the company or retained in the company to meet the future needs of the shareholder is called as cost of reserves or reserves or retained earnings. To maintain or to manage this retained earnings or the reserve, whatever the cost is required to earn by the company is called as cost of reserves. Okay, my question to you is, yes, very good, profit is called as reserve, but not entire profit is called as reserve. Only the part of the profit retained by the company to meet the future needs, it is called as reserve. Okay, my question to you is, reserves belongs to whom? Can anyone tell me to whom this reserve belongs to? To whom reserve belongs? Sorry for the interruption. Okay, so here the cost of reserve, the reserve belongs to whom? To whom this reserves belongs to? Yes, very good. Reserve belongs to equity shareholders, right? So this, when this reserve is also a part of the profit of the equity shareholders, then we can use the same formula what we use to calculate cost of equity. Means the formula for cost of reserve is same as cost of equity because this reserves belongs to equity shareholders only. Next is overall cost of capital. What is called as overall cost of capital? See, these are the individual cost. One is cost of debt, cost of preference, cost of equity, cost of reserves, or the individual cost of capital. Whereas, but considering the total capital, suppose the company is having 10 lakh rupees of capital with them. With this 10 lakh rupees of capital, they are having the sources like 3 lakh rupees of debt capital, 3 lakh rupees of preferential capital and 4 lakh rupees of equity capital they have. Like this, they have acquired from various sources. This overall cost of capital, the overall cost of capital is relating to the total 10 lakh what I said. That means the total cost of capital. Overall cost of capital in the sense what? Total cost of capital. This overall cost of capital is also called as weighted average cost of capital. Weighted average cost of capital. This weighted average cost of capital is denoted as K naught or KO. Let us look into the formula of this. KO is equal to, that is overall cost of capital or the weighted average cost of capital or weighted average cost of capital. This weighted average cost of capital is also called as WACC. Weighted average cost of capital. The formula for this is, what we have to do, by taking all the cost, all the different types of cost of capital, we take the total overall cost for the company. The cost the company required to earn to meet the total capital is called as overall cost of capital. So for this, we take the formula like cost of debt into cost of debt into weight of debt, cost of debt into weight of debt, cost of debt into weight of debt, plus next is cost of preference, right? Cost of preference into weight of preference plus cost of equity into weight of equity plus cost of retained earnings or reserves into weight of retained earnings. The summation or the total of this is called as overall cost of capital. Overall cost of capital, summation, this is the total summation of cost of debt into weight of debt plus cost of preference into weight of preference plus cost of equity into weight of equity plus cost of reserves into weight of reserves. This is called as overall cost of capital. Let us now discuss we'll solve one problem based on this. I'll just copy the problem for you from the question paper. Wait. This is 2012 question paper 81, 2012 question paper. Here they have asked us to calculate weighted average cost of capital. Just look at the problem. We'll give the solution by solving this after understanding the problem. Look at the problem here. Okay. Excel Industries Limited has assets of rupees 1,60,000 which have been financed with rupees 52,000 of debt and 90,000 rupees of equity and a general reserve of rupees 18,000. The firm's total profit after interest and taxes for the year were rupees 13,500. It pays 8% interest on borrowed capital or borrowed fund and is in the bracket of 40% tax rate. It has 900 equity shares of rupees 100 each, selling at a market price of rupees 120 per share. What is the weighted average cost of capital? So here in this problem, they have not mentioned, they have given information relating to the sources of capital, total capital of the company. The company is having a total capital of 1,60,000. This 1,60,000 is a total capital, of which this 1,60,000 is acquired by with various sources. One is debt capital. Debt capital is 52,000 rupees. Then equity capital is 90,000 rupees and general reserve is 18,000 rupees. That means we have three sources of capital. One is 52,000 of debt, 90,000 of equity and a general reserve of 18,000. And for debt capital, in order to calculate the cost of debt, what we require? What we require for the debt capital? Interest, right? What we pay for the debt holders, it is interest only. So when we pay interest to the debt holder, what is the rate of interest here? 8% is the rate of interest, right? So 8% is the rate of interest. This 8% is to be calculated, and for making the payment of interest, it is to be calculated on the cost, on the cost of capital, on the capital, that is on the debt capital, right? Okay, so if the video is not clear, it may be problem from your side. Okay, here video and audio, everything is clear from our end. Kindly check your network issue from your end. Okay, come back. This cost of, for this we have to calculate cost of debt first. Next is cost of equity. So for equity capital, what we require? For equity capital, we need earning per share and the market price per share. Earning per share and the market price per share is required. Next, general reserve. For general reserve, the formula is also same as equity, cost of equity formula. Now, for calculating this cost of debt, cost of equity and general reserve, let us look into the information given in the problem. First one is for cost of given information, cost of, one is cost of debt. Cost of debt, cost of debt is denoted as KD. Cost of debt is denoted as KD. KD is a cost of debt. The formula for this is I into 1 minus tax. I into 1 minus tax. What is I here? Interest, right? What is the amount of interest? Here they said it pays 8% interest. Look at here, if in case in the problem they have mentioned interest is after tax cost. Interest is after tax cost. If it is specified in the problem, no need of deducting tax there. If not, we have to. If the tax rate is given and if not specified in the problem, we have to deduct tax. Take 8%. 8% in the sense I will take in terms of decimal here. 8%, or you can take directly also. 8%. If you take decimal, it will be easy for calculation. 0.08. That is 8% if you convert that into decimal. Into 1 minus tax. Tax is how much? 40%. 1 minus 0.4. Simplify this. 0.08. 0.08 into 1 minus 40% means it is 60%. So 0.08 into 60%. That is 0.08 into 0.6. It is 0.048. 0.048. If you multiply this by 100, you will get in terms of percentage. So I will take in terms of decimal only. At the end, we'll convert that into a percentage after all calculation of overall cost of capital, that is weighted average cost of capital. Next is, let us calculate cost of equity. What is the formula for cost of equity? Formula for cost of equity. Cost of equity is cost of equity is equal to MPS. I'll copy the same formula. EPS divided by MPS. And here, just check in the problem whether is there any growth rate. Is there any growth rate? Are they given any information relating to the growth rate? If information relating to growth rate is not given, let us take this only. EPS divided by MPS into 100. And look at the problem further. They said the firm's total profits after interest and taxes for the year were rupees 13,500. It pays 8% interest on borrowed fund and is in the 40% tax bracket. It has 900 equity shares of rupees 100 each, selling at a market price of 120 per share. In the sense, market price per share is given. Market price per share. Look at here, they have mentioned market price per share. Market price per share is how much? 120 rupees. However, they have not mentioned EPS, that is earning per share directly, for which they have given an information to calculate EPS. So for which, let us calculate calculation of EPS. Let us calculate EPS. How to calculate EPS? You already know about the income statement to calculate EPS, right? Go for the income statement. What the information is given first? Look at here. The firm's total profit after interest and tax. Profit after interest and tax. Profit after interest and tax. It is EAT. After tax, 13,500. This profit after interest and tax is how much? It is 13,500. So now what we have to deduct? We have to deduct preference dividend. Is there any preference dividend? There is no preference capital at all here. When there is no preference capital, there is no preference dividend. So whatever the amount left is called earnings available to equity shareholders. Earnings available to equity shareholders. Earnings available to equity shareholders is 13,500 only. Now, You have got earnings available to equity shareholders and write down the number of equity shares it is given in the problem. Look at the problem. Earning per share, sorry, number of equity shares, they have specified somewhere here. Look at here. It has 900 equity shares of rupees 100 each. What is the number of shares, equity shares existed in the company? 900. Number of shares, this is earnings available to the equity shareholder is 13,500 rupees and number of shares it is 900 shares. Now calculate EPS. What is the formula of EPS? EPS is earnings available to equity shareholders divided by number of equity shareholders. I'll take this as A and this as B. A divided by B. So earning per share is equal to A divided by B. Now calculate this and tell me what is the earning per share. 13,500 divided by 900. It is rupees 15 per share. Rupees 15 per share. So you have got earning per share, right? Now you can directly substitute the value to this formula, right? Let me take this as working note. Now substitute the values to the formula. Cost of equity is equal to earning per share. Earning per share you have calculated just now. How much it is? It is 15 rupees per share, right? 15 divided by market price per share is 120. It is given in the problem. Multiply by 100. Now tell me what is the value? 15 divided by 120 into 100. It is 12.5. 12.5% year. But I'll convert this into decimal. If you divide this by 100, that is by 100, 12.5 divided by 100, then you will get decimal 0.125. And cost of debt is 0.048. So you have got cost of debt, cost of equity also. Next, what you have to do? You have to calculate cost of reserves. Cost of reserves and cost of general reserve. This cost of reserves denoted as KE, and as we know, cost of reserves is same as cost of equity. Therefore, it is 0.125 0.125 only. Okay. Now let us move to the calculation part now, that is computation of weighted average cost of capital. Insert column. First column is sources of capital. There are three different sources of capital. First one is debt capital. And this debt capital is having 8% interest. Next, we have equity share capital. Then we have general reserve. This is about the sources of capital. Next, what we have to do? We have to take down the amount of capital. Amount of capital. So, what is the amount of debt capital? Out of 1,60,000, amount of debt capital is 52,000. 52,000. Then 90,000 is equity share capital, and general reserve it is 18,000. General reserve it is 18,000. Take the total of this is you will get the total capital. What is the total capital? It is given in the problem only, right? That is 1,60,000 is the total capital. So we have got amount of capital. Based on amount of capital, we have to calculate weighted weights. We have to calculate what? Weights. Or you can also call it as weight of capital. How to calculate weight of capital is a question. How to calculate weight of capital? In order to calculate weight of capital, we need a total capital. I'll just give an example for you. The company is having 1 lakh rupees of capital. This 1 lakh rupees of capital is acquired by the company or invested to the company through 50,000 of equity and 50,000 of debt capital. Now tell me, what is the proportionate of equity and proportionate of debt capital out of total capital? You can easily say, right? The equity capital is 50% and the debt capital is 50%. Am I correct? Have you got this 50%? We can see that the total capital is 1 lakh and 50%, that is 50,000 is equity capital. So 50%. 50% of the total capital is equity capital. That 50% what we say is 50% what we say is called weights. Weight of capital here. 50% is the weight of capital. But in this problem, there is no same capital, or the proportionate is not easy to say directly that what is the percentage of debt capital, what is the percentage or proportionate of equity and reserve is there in the company. So for which what we have to do, you have to calculate by using the formula like 52,000 divided by 1,60,000 into 100. If you do that, you will get the proportionate. That is 32.5% of the total capital is debt capital. But I'll take this in terms of decimal only. Next is 90,000 divided by 1,60,000. That is, the proportionate of equity capital is 0.5625. Next, that means 56.25% is equity capital. Then 18,000 divided by 1,60,000 into 100. 11.25% is reserves, the proportionate of reserves. So like this, we have to calculate reserve. How you have calculated this? 18,000 divided by 1,60,000. Now calculate cost of capital. This cost of capital is denoted as K and the weight of capital is denoted as W. Now, for debt capital, since we have already calculated the cost of debt here, you can directly take it as it is. If not, you are supposed to calculate now. Okay. So, since you are already calculated, take the value for the cost of debt. It is 0.048. And cost of equity 0.125, and it is same for cost of reserve also. Lastly, what you have to do, you have to calculate weighted average cost of capital or overall cost of capital. Now multiply weight of capital into cost of capital. Weight of capital is what? Weight of capital is 0.325 into 0.048 is how much? It is 0.0156. Next, how you have calculated? Did you get it? So look at here, WACC. In order to calculate WACC, we use a formula like weight of capital into cost of capital. You have already calculated the weight and you have also calculated cost of capital. Just multiply this weight into cost. Means weight of debt capital into cost of debt capital is 0.0156. Next, weight of equity share capital, that is 0.5 5625 into 0.125 is 0.0703. This is cost of equity. Then 0.1125 into 0.125 is 0.014. If you round it off, you'll get 1. So this is about cost of reserve. Now take the total of all these three: 0.0156, 0.0703, 0.0141. So total 0.0156, 0.0703, 0.0141. Total is how much? 0.1. What is this 0.1? This is WACC. Or by using the formula, what is the formula here? Weight of capital into cost of capital. Or overall cost of capital. This is a formula, right? Even if you substitute, look at here. If you substitute cost of that is weight of capital, debt into cost of debt, plus weight of, here there is no preference, weight of equity into cost of equity, plus weight of reserves into cost of reserves. If you add these three, you will get what? You will get the overall cost of capital. How much you got the overall cost of capital? It is 0.1. If you want to convert this in terms of percentage, that is 0.1 into 100. How much you'll get? 10%. Means on an average, the company must have to earn 10% to maintain or manage the capital in the business. Understood? This is very simple one. Very simple one. If you know the formula how to calculate it, then you can easily do the problem. If you wish, I will do one more problem for this. Or let me go for another concept. Can you tell me? Shall I do one more problem for this, or shall I go for another method? You can write me in the chat box. Until that, I'll search for the questions. One more, right? Okay. So it is okay. This is 2016 question paper. Question paper, fourth one. Okay. Look at this problem. This is relating to WACC only, weighted average cost of capital. ABC Limited has the following capital structure. ABC Limited has the following capital structure. That is 4,000 equity shares of rupees 100 each. 4,000 equity shares of rupees 100 each, 4 lakh. 10% preference shares, that is 1 lakh. 11% debenture, that is 5 lakh. The current market price of the share is rupees 102. The company is expected to declare a dividend of rupees 10 at the end of current year with an expected growth rate of 10%. Look at here, there are three sources of capital given. One is equity, other one is preference, and the other one is last one is debenture. And the company has a market price per share of 1 or 2. This is MPS, market price per share. Why this is required? This is required for calculation of cost of equity. And the company is expected to declare a dividend of 10 rupees at the end of current year. In the sense, earning per share means what? Earning per share is nothing but the earning for 1 unit of share. What is the earnings available by the equity shareholder? Here, the company is expected to pay 10 rupees as a dividend. To whom? It is to the equity shareholders. So the earnings to the equity shareholder is nothing but dividend to the equity shareholder. Earning means part of the profit to the equity shareholders, that is 10%, 10 rupees is decided by the company to pay returns to the equity shareholder, that is EPS, or you can take that as a DPS also, with an expected growth rate of a growth rate of 10%. There is a growth rate in this problem. The applicable tax rate is 50%. Find out the cost of equity capital, capital and WACC. Find out the cost of equity capital and the WACC. Since information relating to equity capital is given, they've asked us to calculate. So without calculating cost of equity capital, even if not given also in the question, we are required to calculate this cost of equity capital, right? And also they've asked us to calculate weighted average cost of capital. Further, there is a continued information. One is, next is, assuming that the company can raise additional rupees 3 lakhs 12% debentures, additional 3 lakh rupees, 12% debentures. Find out the new weighted average cost of capital if dividend is increased from rupees 10 to rupees 12. Look at here, the company is going for raising an additional capital of rupees 3 lakh with 12% debenture. There is already a debenture at 11% in the capital structure, but they are going for raising another 3 lakh rupees with 12% debenture. We have to take that separately as a separate sources of capital. Next, if additional capital is raised, then there is changes in the dividend, growth rate and market price also. Dividend is increased from 10 rupees to 12 rupees. That is earning per share or dividend per share to the equity shareholder is increasing from 10 rupees to 12 rupees. And growth rate is reduced from 10% to 8%. And the market price is also reduced to 98 rupees. So with this information, we have to calculate weighted average cost of capital. Let us work out quickly. Okay. Okay, let us write the given information or let us calculate the cost of capital first. First one is cost of equity. Cost of equity. Cost of equity is denoted as KE. Formula for this is, there is a growth rate. Look at here in the problem, there is a growth rate of 10%. So you have to use the growth rate here. EPS divided by MPS into 100 plus G. EPS divided by MPS into 100 plus G. This is a formula. Now substitute the values to this formula. EPS is the set, it is specified in the problem also. Earning per share, that or the dividend paid to the equity shareholder is rupees 10 divided by market price per share is 1 or 2, then multiplied by 100 plus growth rate. Growth rate is how much? 10%. Since you are multiplying here by 100, I will take this in terms of percentage only. That is 10, simplify this, 10 divided by 1 or 2 into 100. 9.8 into 100 means percent plus 10%. 9.8% plus 10%. In the sense it is 19.8%. Or you can convert this in terms of percentage. That is 0.198. This is cost of equity. Are you understanding this? cost of equity. So if you know the formula, just substitute the value based on the information given here. Okay. Next, cost of preference. Preference share capital is given. So calculate cost of preference. What is the formula for cost of preference? Preference dividend divided by net proceeds. In case if the rate of preference is not given. If the rate of preference is given, we can directly take that. Look at here. 10% preference share. There must be fixed rate of preference share, right? So this is a 10% preference share is the cost of preference is 10%, or you can directly take it as 0.1. Next is cost of debenture. This is cost of 10% preference share, cost of 11% debentures, cost of 11% debenture. Okay, so cost of debenture is equal to, what is the rate of interest? 11%. And the question is whether it is after tax cost or not. Nothing is stated. If nothing is stated, we have to deduct tax from it by using the formula. What is the formula? Interest into 1 minus tax. Sometimes they will mention, specify the interest amount, rate of interest, saying after tax cost. If they specify this as after tax cost, we need not take tax amount or deduct tax amount from this interest. Okay. Interest is 11%. You can take that as 0.11 into 1 minus tax. Tax rate here is how much? Look at the problem. And specify the tax rate. Yes, it is 50%. 50% means 0.15. Simplify and tell me. 0.11 into 1 minus 0.5. 1 minus 0.5 means it is 0.5 only. So 0.11 into 0.5, it is 0.055. 0.055. So this is the given information for the calculation of weighted average cost of capital for the existing capital structure. I will also explain you how to calculate for the 12%. You can directly calculate by using this same formula. 12% debenture means interest rate is 12%, that is 0.12, and into 1 minus tax rate is 50%. 1 minus 50% means it is remaining 50%, 0.5 only. So 0.5 into 0.12. 0.5 into 0.12 is how much? 0.5 into 0.12. 0.06. 0.06. I will copy the same table. Okay. So let us now calculate the weighted average cost of capital. Weighted average cost of capital. This is, I will take this as case 1. Computation of weighted average cost of capital for existing capital structure. For existing capital structure. So what is the existing capital structure? First one is equity share capital. Then second one is, what is the second one? 10% preference share capital. 10% preference share capital, and third one is 11% debentures. 11% debenture. Now, what is the amount of equity share capital here? The amount of equity share capital is 4 lakhs, and preference share capital is 1 lakh. Debenture is 5 lakhs. What's the total capital? It is 10 lakhs. So now you can directly take that 40%. 40% means 0.4 takes, right? You can easily take this because 40 lakh, 4 lakh divided by 10 lakh into 100 means 40%. 40 lakh, 40%, if you convert this in terms of decimal, it is 0.4. 10% means 0.1. 50% means it is 0.5. This is about weight of capital. Now calculate, substitute, take the cost of capital here. Since you already calculated the cost of capital, you can take directly. Cost of capital, first one is cost of equity, right? Cost of equity is how much? 0.198. Take that. 0.198 is a equity share capital and 10% preference is 0.1. Then debenture that is 11% debenture is 0.05. You may have the question here, why this 12% debenture is not taken for these sources? Am I correct? Because look at the problem once again. There is an existing capital structure with only 3 sources of capital. And the first question is also to find out the weighted average cost of capital for the existing structure only. And the second question is, if there is another additional capital, what will be the new WACC? So for that, case 2, that is calculation of new WACC when there is an additional capital raised, will be taken as a case 2. But for the case 1, there is only 3 sources of capital. Got it? Now, what next you have to do? You have to multiply. That is weight into cost. Weight of equity capital is 0.4 into 0.198. It is 0.0792. Next is 0.1 into 0.1. 0.1 into 0.1 is how much? 0.01. Next is 0.5 into 0.055. It is 0.0275. Next, take the total of this is called as WACC. It is very simple now. If you know the formula to calculate, then it is very easy to calculate. 0.1167. So, now what you have to do? You can just take overall cost of capital as 0.1167 or WACC. You can also take this as WACC. Multiplied by 100. If you multiply this by 100, then you will get 11.67%. This is the final value. Final value. Next is case 2. Case 2 is what? Look at this case 2. Computation of weighted average, that is new weighted average cost of capital when additional capital is raised. When additional capital is raised, what is the new weighted average cost of capital? I'll copy the table for this. So there are already 3 different sources of capital. 3 different sources of capital. What are the 3 different sources of capital? Equity share capital, preference share capital, and 11% debenture. What is the additional capital raised? Additional capital is 12% debenture. How much? What is the additional capital amount? 3 lakh. Right? Take this 3 lakh here. Now, what is the total capital? It is 13 lakh, sorry. First one is equity share capital of 4 lakh. Second one is 10 lakh preferential capital. Third one is 11% debenture and fourth one is 12% debenture. So you may have the question even here also that can't we take the total of debenture together? No, definitely you cannot take it, because this 11% debenture, the rate itself is differs, and also the cost of capital also varies. If you combine that, your problem is wrong. Okay, so you have to take this cost of capital separately when there is a separate cost. Now calculate weight of capital. In the previous case, we have taken directly because that was easy. But now, is it that easy to take directly the weights? No, right? So let us calculate this weights for the capital. First one is 4 lakh is the equity capital divided by 13 lakh. How much it is? 4 lakh divided by 13 lakh. It is 0.31. 0.31. I had rounded off this. 1 lakh divided by 1 lakh divided by 13 lakh. 1 lakh divided by 13 lakh. This 1 lakh divided by 13 lakh is 0.08. Next is 5 lakh divided by 13 lakh. 5 lakh divided by 13 lakh is 0.38. Next is 3 lakh divided by 13 lakh. 3 lakh divided by 13 lakh is 0.23. Now, take the cost of capital as you already calculated. Cost of equity is 0.198. 0.198. Then the cost of preference, it is 0.1. Sorry, 0.01 or 0.01 or 0.1. So 0.1 it is. Okay. Next, 11% debenture, it is 0.055. Next is 12% debenture, it is 0.06. What you have to do now? Just multiply these two and take the total. Are you understanding? Is there any doubt with this? Can you do at least this calculation now? You can calculate this, right? Yes, I'll share the notes in the Telegram group. Will you calculate the weighted average cost of capital for the second case? That is new weighted average cost of capital when the additional capital is raised. Yes? Okay, right. And I wanted to inform you in the previous class while doing the problem relating to the capital budgeting. Look at the previous day problem. Okay. Here, this IRR, while explaining, I had, while taking this, I had in the previous, if you look into the video of the previous class, if you have watched the video of the previous class, you might have seen, and one of your friend raised, then I get to know that I have done a mistake there. So while giving the formula in the beginning, I had given correctly, but while doing the problem, I had taken this C minus O, instead C minus O as C minus D, and C minus D in the denominator, C minus D as C minus O. There was an interchange. Due to that interchange, your value, the final IRR value was also changed. So later, after knowing that I had been done a mistake, then I corrected and sent the file. After correcting this in the notes, I sent a corrected notes also to the group. Kindly check it and make a correction. Okay. Thank you very much. By do this weighted average cost of capital, the remaining problem, I'll share the notes to you right now. Further, by next class, we'll continue with new topic. Okay. Thank you very much.